Interest rates are rising, so what should you be doing if you're looking to buy your first home in the UK in this current climate? In my last video, I actually looked at how rising interest rates can be an opportunity for first-time buyers. But in this video, I'm going to be looking at what you should be doing step by step to guarantee success when buying your first home in this current climate. Now, I'm seeing 3 massive mistakes right now, and I have to tell you them. The biggest one is people are waiting until things get better. Now, people have been trying to time the market for as long as the market has existed. Has anyone succeeded? Yes, some people have. Have most people succeeded when trying to time the market? No, absolutely not. There is not a perfect time to go into the market. But in most scenarios, if we're looking over the past history, getting into the market earlier is far more advantageous than waiting for the perfect moment that never comes. Now, sure, you could say I could have bought a house at the absolute perfect moment in 2008, 2009, but not many people did. And the other question we get is, will we see another 2008, 2009 where properties crashed? We'd have to get the glass ball out and make a prediction, but the chances are that we're not going to see something along those lines, where in actual fact, we're going to see inflation tracking higher than the house price inflation. So technically a market crash, but not really framed in the same way you'd probably expect it, where house prices themselves drop. The second big mistake I see a lot of people doing is not understanding the affordability changes that have happened due to higher interest rates. Those of you that were speaking to advisors in January or February 2026, or even slightly before then, your understanding of affordability is now incorrect compared to today's rates. And don't worry, we'll look over that in a little bit more detail in the step-by-step guide. And the third mistake I'm seeing so many people making right now is approaching a mortgage advisor too late. Understanding your budget really early on in the process is absolutely integral to really great planning, which is going to get you a really great outcome. The winners are the people who are preparing. Now, spoiler alert, I'm going to be giving you 7 absolutely integral steps that you can avoid these 3 big mistakes. You can get the most out of the market, and you can really get the ball rolling and take advantage of higher interest rates, which sounds crazy, but the document that you are seeing flashed on your screen right now, blurred out, is the complete document that we have available at the end of the video. And again, we're going to work our way through it throughout the video. All 7 steps, nice, simple, crystal clear, and all the timestamps will be in the video as well. So you can sort of jump between different ones, go back, go forward, whatever you deem necessary. But an awful lot of information that is valuable to you, the first-time buyer. Now, I already mentioned it, but I'm going to be looking at Rates Are Rising, your step-by-step buyer guide. Now, this can be used as a first-time buyer, it can be used as a second-time buyer, but this is mainly targeted for first-time buyers looking to enter the market while rates are rising, or just actually in general looking to enter the market. Now, step 1 is to create a budget. Now, this step 1 is super important because higher rates equals less borrowing power. Now, no, it doesn't mean that the lenders are able to turn around and say you're not able to get your 5.5 or 6 times lending, whatever you would have been approved for just 4, 5, 6 months ago, or even when interest rates were lower in a separate context. But your borrowing power is reduced because what you can afford to pay on a monthly basis, unless your pay has also just gone up, which would be really nice and convenient. But the chances are, if it hasn't gone up, your borrowing power has been reduced, because if you can only commit £1,600 a month towards a mortgage, the amount that you can borrow based on what you can afford on a monthly basis is now different because of higher interest rates. Again, you've got some flexibility there with mortgage terms, but creating a budget is step 1. Now, I have to mention that monthly cost is way more important than timing the market. Understanding what you can afford to buy today, tomorrow, and in the sort of short to medium term, if you will, is way more important than waiting for the perfect interest rate. That's never going to come. You're never going to get the perfect interest rate. Look at all the predictions, and I can actually say quite confidently that most predictions are going to end up being wrong anyway, because that's just what they are, predictions. But timing the market is not going to help you. Understanding your monthly costs and making that fit to your own personal circumstances is what creates a real budget, and it really does solidify what options you've got right now, which is going to help you today, tomorrow, and for the long term. And finally, I have to make the point, what you could borrow 12 months ago is not what you can borrow today. Like I mentioned, if you have a specific budget for what you can afford on a monthly basis, the amount that you can borrow is lower. Now, step 2 is hopefully an obvious one. Speak to a broker early, speak to a mortgage advisor early. So you can book in a call with myself using the top link in the description to essentially go through your circumstances, talk about your own situation, which can actually refer back to step one and help you create a budget. So speaking to a mortgage advisor really, really early on in the process is just going to make your life so much easier and make the planning process a lot less stressful. A mortgage advisor is going to help understand affordability and deposit. Now we can actually look at these and split them into two. So understanding affordability is really, really important because you need to look at what mortgage term you're going for, what fixed deal you're going for, and essentially divide that into what you can afford on a monthly basis, which again kind of refers back to that budget we've previously discussed. And then the second part there is deposit. Now, deposit is really, really important because a lot of people come in with a different idea about deposit to actually what you should come into, which is budgeting your deposit to ensure that when you commit to putting a certain amount of money on a property, not only are you getting the most out of it for, let's say, mortgage interest rates, so getting yourself the best rate possible by putting in a specific amount of money, but also getting the most out of it in the fact that you don't move into the property with absolutely no money left over and you can't buy any furniture. And I appreciate and I love the fact that people are trying to build up from basically little to nothing and building up over time. But if that is at the detriment to your short-term, long-term, and even medium-term planning and just mental health in general, then committing too much deposit can be just as problematic as committing too little. So understanding those two with a mortgage advisor's help is incredibly important. Now, I briefly touched on it, but a term and fixed rate consideration, these two split into two, are extremely, extremely important. And it's something that a mortgage advisor can talk you through very, very easily and help you understand what this means for your budget, what this means for your long-term planning as well. And overall, it's such an important step in your process to understand both these components. But put simply, the term is how long you pay the mortgage across. You can change this throughout the term of the mortgage. So let's say you commit to a 40-year mortgage term. I'm going to clear that mortgage within 40 years. The second thing you're going to do is pick a fixed rate. So considering which rate to go for, which is mainly going to be focused more on your short to medium term plans, so 2, maybe 5-year fixed deals, is really, really important because essentially what you're doing is saying, right, in 2 years, I'm going to look at this again, or in 5 years, I'm going to look at this again. But it's extremely, extremely important because if you have the flexibility to go for a 2-year fixed deal, that means in 2 years' time, you can potentially look at that interest rate again and say, right, well, now the rate is potentially lower. I'm now going to reduce my term. So in 2 years' time, you'd have, let's say, 38 years remaining. You could then say, actually, I can afford a bit more. I'm going to reduce that right down to 30 years. And the other thing to consider as well is you have the ability to make overpayments without any fees with pretty much all lenders up to 10%. And there are a couple of lenders out there that will allow you to do up to 20% of the mortgage balance per year. Now, finally, I want to make a note here. Most people wait until they've found a property to discuss things with an advisor. That's already too late, in my opinion. Most experienced advisors can actually help you on the buying journey way before you actually find a property. And if you speak to myself, I'd actually help you on that journey of looking at houses in online valuations, my own opinion, talking to estate agents. So again, using that expertise comes in handy prior to finding the right property because it might just help you find the right property. Of course, you're the one that makes the final decision because you're the one that lives there, but combining something that is really great for you personally, as well as a great financial decision, is something that a good advisor can help you with. And again, if you want help with that, top of the description, book in a call, we can go through it together. Now, your next step on the journey is to get your agreement in principle. So get your AIP. Now, what is an agreement in principle? Now, an agreement in principle is following your conversation with a mortgage advisor in the UK. You can essentially get a document that tells you, right, this is how much you can borrow, this is what deposit you've got available, combine the two, this is how much you can buy a property for. Now, again, you can just go off maximum multiples, which some advisors will. So we're going to give you 6 times your income, we're going to take your deposit, bang, those two numbers together, we're happy to go. And then the better approach to take there is, right, well, this is the income, this is what money's left over every single month, this is what I can commit towards a mortgage payment, and then this is the deposit. Put those two together, and then you've got the maximum that you can actually afford, not what a lender's willing to give you, which are 2 separate numbers. But step 3 in the process, getting your agreement in principle, is not just about having this physical document. It proves to sellers that you are a serious buyer. You are ready to move, you are serious, you've taken these steps to basically go and get yourself ready to move into a property. If you approach an estate agent and you have this already set up, you can basically let them go off and talk to the seller and let them know that you're ready. You're eager, you're ready, and you want to move on this property. So having an agreement in principle is so, so powerful. Something that I didn't add in the document, and I kind of wish I did, was be careful what you share with estate agents. Estate agents work for the seller. So be sure when you say to an estate agent, yes, I've got my agreement in principle, if they ask how much it's for, just say, oh, I'll get my advisor to email it across. Because what I don't want you to do, if you're looking at, let's say, a £400,000 home, you say to the estate agent, right, well, I've got an agreement in principle for 450,000. Guess what? There is a bit of a difference there. So now the estate agent knows that you can afford to go pretty high above what the asking price is. Granted, they're not going to make you pay everything that you can afford towards it. But if someone was offering 400,000 on a property, I'm representing the seller, and someone that can afford £450,000, guess what? I'm probably going to say, well, we've actually had other offers in, I want £410,000. So just be careful what information you share. Let your advisor do a lot of these communications, because we can alter the agreement in line with what you're offering on a property. Not a problem. Helps you, helps me, helps everyone involved. Because again, remember, I represent the buyer, which is you. The estate agent represents the seller. Their only job is to get the best price possible. Don't trust estate agents if you're a buyer. Now, we've briefly touched on it, but step 3, getting your agreement in principle, is absolutely essential for short-term planning, because you now understand how much you can afford to buy a property for the next 2 or 5 years. You have a good understanding of what your mortgage payments will look like and the fact that it's affordable. This means when you're scrolling through Rightmove looking at all these properties, you're actually looking at the ones you can afford to buy, not wasting your time on ones that are 20, 30, 40,000 pounds outside of your budget. And just to finish off step 3, the earlier you get in, the more prepared you are. And the more prepared you are, the more successful you will be in buying your first home. It's going to reduce stress and potentially save you money, all wrapped into one, which is really, really useful. Now, step 4 here is super important. It's to track the market. Now, tracking the market is one of the most important steps you can possibly take, because it helps you understand what's available, what's not available. It helps you understand your geographical locations a little bit more. So if you understand what detached properties that are 3 bedrooms in a certain area are being listed for, because you've looked at so many of them, you now understand that little bit of the market a lot better. So again, tracking the market is really, really important as step 4, but there are some really important bits that we can look at here. The first thing to keep an eye out for is price reductions. Seeing price reductions enter the market is fantastic. And when you have, created your budget, you've spoken to a mortgage advisor, you've got your agreement in principle, when you're looking at the market and you see price reductions where something that was maybe £20,000 outside your asking price is now within sort of £10,000, all of a sudden that could be an option for you. So this is something that is really, really fantastic. If you've been tracking the market, seeing price reductions means either the estate agent thinks the property was listed for too much, or the seller is motivated. They want to get that property gone and they're willing to take a slight hit on what it was listed for. Now, a second important metric here is time on the market. How long has the property been on the market for is a really, really important metric to understand, because yes, you can have a look just for price reductions, but also having a look at how long a property's been listed for is a really, really good indication of the seller's need to sell the property. If a property's been on the market for, let's say, 2, 3, 4, 5, 6 months, for example, the chances are they want that property gone. Most property sellers, if they haven't sold it in that time, they're either reducing the price, and in some scenarios you'll see both, where it's been on for a long time and been reduced, which really stresses the fact that they're a motivated seller. But the other thing is, if a property's been on the market for so long, maybe you're starting to get to a point where, and they haven't had price reductions, the seller could be willing to have a negotiation and discussion there. So important to note. Now, I've said it a few times now, but identifying motivated sellers is one of the most important parts when tracking the market. Now, I've already given you 2 potential tools there, which is looking for price reductions and looking for time the property's been listed on the market for. But a really, really important thing is to get on the phone, or at least employ someone to get on the phone for you. So some mortgage advisors like myself are more than happy to have these phone calls and go off and do a little bit of property research for you in assistance of acquiring your first home. So understanding the seller's position sometimes does require calling the estate agent and just saying, what's the seller's position? Are they going to buy another property? Are they going into a rented address? Just give me a little bit of information on what the seller's looking to do, because if you understand the seller, you understand whether they're motivated to sell. And if you understand if they're motivated to sell, maybe that's going to give you a better indication of what you can buy that property for and whether there is an opportunity there to get a slight discount. So asking the right questions, seeing the right information is all really important part of step 4, which is tracking the market. Now, your next step is the most important part, which is be ready to negotiate. I think being ready to negotiate is super, super important for first-time buyers, especially in a market like this, where yes, you're paying slightly more in interest rate, and also on a monthly basis, potentially that has gone slightly higher than what you were originally planning. But again, keeping it within your budget, step 1, super important. But the important part here is to negotiate. You've got less competition, and less competition means you've got more options. So this is a real buyer's market, but being ready to negotiate is super, super important. So let's dive dive into step 5 in a bit more detail. Now, the first point here is kind of obvious: offer below asking. And I've put there in brackets where justified. And I think that's really, really important. Now, I would be the first one to say properties are being listed left, right, and centre above what they should be listed for, and potentially you'll be getting put into negotiations for something that's potentially listed already for too much. So offer below asking where justified is really, really important because it comes down to research. Now, you can do this using a number of different metrics. Now, the first one we've already kind of done, which is tracking the market. So understanding the area you're looking to buy in, understanding other properties listed in the area, which is a similar spec, a similar size, and a similar build. So if it's detached, semi-detached, all these different things do play a role there. But understanding the local market to see whether or not this property is fairly listed or slightly above or slightly below where you think it should be is really, really important. And another thing to consider here is you can run online valuations using something called Home Track. And again, if you want me to run a home track for you based on a property that you've already seen, then book a call in the link down below and we can go through potential properties you're looking to buy together and potentially see whether or not it's a good deal or not. And again, we covered it in step 4, but identifying motivated sellers does sometimes mean picking up the phone. So if it hasn't been on the market for very long and it hasn't had a price reduction, you can talk to the estate agent to see what the seller's position is and see whether or not there is a conversation to be had about getting a lower price. Some estate agents keep their cards very, very, very close to their chest, so it's hard to see where it's justified, where it's not justified. But others are a little bit more honest and open about the seller's position, which can help you massively and save you thousands and thousands of pounds off the purchase price. And a final point here on negotiations, because I see people get it wrong all the time. Now, I want you to get the best price possible. That is absolutely facts. That is 100% goes without saying situation. I represent the buyer, which is you in this scenario. So what I would say is you are dealing with a person. I know it's really, really easy to go really lowball someone. And if you've ever seen negotiation videos on businesses and things like that, they always say lowball and sort of meet in the middle. This is someone's home in most scenarios. You are buying someone's home. So there's an emotional connection in some situations. So what you want to do in every scenario is do your research. Again, where justified, you can go below asking, and make an offer that is suitable. Make an offer that works for you and works for the seller. Again, what you don't want to do in any scenario is upset the seller, because lowballing has a serious risk of doing that, and you can basically taint the relationship. I see it all the time. People go way, way, way below asking price and they just ruin the relationship with the seller. They do not want to do a deal with you. You've gone too low. You've offended them. There is a person on the other end of every deal. Now, part of negotiations does also come in the form of later negotiations. So you can potentially go at asking price, you can go below asking price at the outset, but when you go ahead and do your private valuation or private survey, I should say, later in the process, and they highlight things that need to be repaired, then you can go ahead and either ask for repairs or reductions. Now, if you have an offer accepted on a property where it looks perfect, you've gone in, you thought, right, this is my future home, there's nothing wrong with it whatsoever, you pay for a level 3 RICS survey, they go out and assess the property, and the roof is in immediate need of repairs, which is going to cost roughly £7,000. You can then say, right, I want £7,000 knocked off the purchase price because we wasn't aware, it wasn't included in what we deemed was a fair value when we agreed the price. Or you can say, right, I want that repaired before we complete and exchange contracts. So both of these really valid responses, but again, can save you thousands and thousands and thousands of pounds from future costs. So again, really important to know. I do have to say surveys, private surveys, are the most looked over thing in the whole transaction of buying a home, but it's one of the most important. So please, 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 if there's anything you take from this video, take a private survey when buying a home, because it's one of the biggest investments you're ever going to make, and you want to make sure that it is what it's advertised to be. Now we are looking at the important parts now. So step 6 is consider fixing. Now, this is quite a broad area here, but it's something that's really, really important as part of this 7-step process. Now, 2 versus 5 year fixed. Now, it's the old typical, the popular mortgage deals, 2 years versus 5 years fixed on that interest rate. Now, what I would say is, without looking at your personal scenario, I can't tell you whether a 2 or 5 year is a better option for yourself, but what you need to consider is affordability. You know, is there scope if that mortgage was to become a higher interest rate and more expensive, which does happen from time to time, even if we are in a really high rate market right now, could you afford a slightly higher mortgage in a couple of years? So the flexibility there can go both ways. It could help you, it could hurt you. If you have the ability to be flexible either way, a 2-year deal is a really, really great option. And if we're looking for something that's more stable, where you think, right, I'm really, really tight on budget here, I can't afford for it to go up, even if there is an off chance that it could be down in 2 years' time, and maybe a 5-year deal is better for you. Gives you time to build equity, gives you time for your income to improve, gives you time for your personal scenario to improve, which in 5 years' time, hopefully it will, as you continue to pay off that mortgage. 5 years, the stable option is way better. And again, we'll make a note of it there, flexibility versus stability. So yeah, really, really important to understand. 2 years offers you flexibility, 5 years offers you a little bit of stability. We are still only talking like short term and medium term, but either way, once you've got that property, hopefully you pick the right property in the other steps above, and that's looked after your long term. So everything in between just sort of helps build towards that longer term goal. Now, something that's often looked over is every rate review is an opportunity. Now, I have clients that every 2 years come to remortgage regardless of the situation. They always go for 2-year fixed terms. Now, this is an intentional plan set out by the client. They know that every 2 years their income's going to be higher, their situation is going to be better. And again, I know that's not sustainable for absolutely everyone, but there are a lot of clients where that is the case. You know, your income goes up every April for a lot of people if it keeps in line with inflation and your employer is very generous. And again, for those of you that are on national living wage, again, it will go up every April anyway. Again, whether it's 2, 3, 4, 5, even 6% in some years, which is crazy. But again, your increased income will help your position because it means you should technically be able to commit more money towards the mortgage. So every 2 or 5 years or 3 years, whichever fixed deal you end up going for, you can look at that mortgage term. So if you are paying a mortgage off for 40 years and the interest rate goes down after 2 years, or your income goes up and you can afford to commit more money towards the mortgage, you can reduce that term down by multiple years in most cases by just committing either a little bit more money towards the mortgage, or if the rate comes down, just committing the same amount of money towards a mortgage. So it's not always about going for the lowest monthly payments. It's about going for the best plan for your short, medium, and long term. Do not sleep on the opportunity to review your mortgage every 2, 3, or 5 years and review the mortgage term. Don't go just for the cheapest. Now, finally, step 7, which is focus on the long term. It's important to note rates always change. And unfortunately for myself, rates do change pretty much every single day from lender to lender. Now, not every lender changes their rates every day, but because of the vast majority of lenders changing rates at least weekly in some scenarios, you end up seeing new rates every single day across the market, across different loans of values, and across different purchase prices as well. So rates are always changing. Do not focus on rates as much as you focus on, let's say, your budget and the other 6 steps before this one. Your property value is always going to be more important than the rates that you have. So getting a good property value, or at least getting a property where you can see yourself for the long term, is way more important than what interest rate you run for the next 2, 3, or 5 years. If you are committed to that property for 10, 15, 20 years, it's all going to average out, and not timing the market is going to help you massively and help your family massively, because you entered the market when the time was right, not trying to time the market when the market was right, because no one times the market correctly. And to wrap off step number 7, it's nice and clear. Long term is way more important than the short term, but make sure that whatever you do and whatever you set up for the long term works for the short term. So long-term plans are the absolute top priority, but it needs to ensure that the short term works. I promise you, if you follow all 7 of these steps right here, you're going to guarantee success. Pause the video, screenshot it, go back through the timestamps. But if you follow this, you create your budget, you speak to a mortgage advisor, you get your agreement in principle, you track the market, understand the market, you get ready to negotiate, you consider fixing your mortgage, as in what interest rate and what fixed period you should go for. And you also look to review that every 2, 3, or 5 years. And you focus on long-term gain, not short-term. You're going to massively improve your own personal scenario, not only just for yourself, but your family and whoever you're buying the property with, because you're going to ensure that your long-term is planned for. You're in the property, you build equity, you remortgage onto cheaper rates, you remortgage in a smart way that decreases the term, which means that your mortgage is paid off way faster than it would have been. So again, all these different steps are guaranteeing you success as a first-time buyer in this market. So what have we learned? Don't wait for perfect rates. They don't happen. Don't max out your budget so much so that you are a slave to your mortgage, because let's be honest, we all want to own a house, but we don't want to be a slave to our house. We want to continue living our life and live in a nice home. And don't rely on outdated advice from friends and family. Go speak to an actual mortgage advisor who can provide you all details on the active market and what you should be doing for your short term, medium term, and long term. And you can work with an advisor to create a plan. So you can do that with me, booking a call in the description. We can go through your personal scenario together, make sure that whatever plan we put together is right for you and whoever you're buying with's future. I help people every single day in the exact same scenario. So booking your call, it's going to be nice and stress-free. It's all about you anyway, so any questions you have will be answered on the call, and it's nice and straightforward. Now I want you to click on the video on your screen right now, which is how much you can borrow in today's market. Really, really important to understand, really, really important to get a budget put together, which is step one in this video anyway, and this video on your screen is going to help enable you to do that. So click on the video, go through it, and I look forward to speaking to you very soon.